Hi there, welcome to Economic Observations. My name is Chris and today is the 22nd of April. Thank you so much for watching. This video is brought to you by the Tanzania School Foundation, a nonprofit near and dear to my heart. There are links in the description below should you like to learn more. TSF is a small organization. So small that we can't open up a cryptocurrency account because you need $1 million. Well, we don't even raise a tenth of that. But anyway, there are links in the description. If you'd like to support this channel, please consider making a donation. All the money goes to help support education in Tanzania. All right, let's see. Fed Powell is taking an aggressive approach on raising interest rates and says earlier today that in the May meeting that a 0.5% interest rate is not off the table and is probably very likely, and he has the support of many others. You know, the economy's going strong, the stock market was strong, labor market is strong, and now is a good time to raise interest rates. But what happens when we raise interest rates? Well, according to so many, and especially on YouTube, everyone looks at the economic point of the individual, right? So buying a home is going to cost so much more expensive. Borrowing money on your credit card, buying a car if you need to take a loan is going to be that much more expensive. It is going to hit individuals, but it's also going to hit small businesses and large businesses. And you say, well, how is it going to affect them? Well, many companies, I'd say probably all companies, borrow money. That's how they survive. They borrow money today and they kick the can down the road for tomorrow, all based on future earnings. Similar to what the United States and many other countries are doing when they print money, they kick the can down the road. Well, it's easy to kick the can down the road when interest rates are low. It spurs growth. It spurs spending. People can spend more. Companies can spend more because they are getting cheap money. But when money isn't cheap anymore, well, the whole system's going to collapse. And maybe not collapse for everybody, but it's going to collapse for a lot of people. So when companies can't spend money, or they have to pull back too, and not only do they have to borrow money at a higher interest rate, the demand for their product and services is waning because people like you and I don't have the money to pay higher interest rates. So we're not talking about inflation and higher costs, we're talking about higher costs for borrowing money. So people are going to pull back. If you're paying 16% on your credit card and it all of a sudden goes up to 21%, well, it might prevent you from putting that purchase on it. Borrowing money for a car now costs you 8% instead of 6%, well, people might withdraw. And we all know that the price of housing, if people look at their monthly payment, and if they can't afford the monthly payment, especially with the prices as they are now, they're not going to buy that house. And now is a good time to rein in that inflation and stop the demand. But when you stop the demand, companies suffer. Their revenues suffer because people aren't buying their products and services. So now that they're not buying their products and services, and the cost of borrowing money is higher for a corporation, especially to innovate and create new services or goods, they're going to be hit hard. And what happens when their revenue declines, their borrowing rates increase? Well, that is going to increase the layoffs, and employees are going to lose their jobs. And that is a telltale sign of what's going to happen. I mean, just think about it. It's pretty common sense. So people are going to lose their jobs. The value of these corporations has got to come down because they're not worth as much as they used to be because they can't borrow as much money. And when they can't borrow as much money, it affects the whole economy. So there will be higher unemployment rates, and the Fed put this into their calculations of raising a 0.5% because the labor market is so strong right now. We can afford to lose jobs, and that is a telltale sign that why they do it when employment is strong, because If 1 million people lose their job, the Fed calculates that the unemployment rate will still be low and the economy can afford to lose those jobs. But let's see what happens. And maybe it's not 1 million people. Maybe it's millions of people. They say that, there are more jobs than people out there. I'm not convinced of that, but that's what they're telling us. Unemployment numbers were 185,000 yesterday. There's a lag, just like there's a lag with hospitalizations and COVID. There's a lag with interest rates rising and the effects of what it's going to bring. So I think come the fall, we're going to see higher unemployment, especially if the Fed is aggressively raising interest rates. Stock prices are going to suffer. Bond prices on lower yield bonds are going to suffer, especially if more bonds are being issued at higher rates. People are going to want those. Those prices are going to be higher, and the interest on the price on lower interest bonds are going to wane. People are looking at inverse yield curves and all these charts. Just think about it. As much as it's going to affect you and I, it's going to affect businesses, both small and large. And there's a lot of zombie companies out there, and there are a lot of zombie companies that are going to fail. And maybe they're not the big publicly traded companies. Well, maybe there are a few of those. But a lot of small businesses, they rely on credit. They have a revolving credit that supports their business. It pays their payroll. And the income that they earn is for the future of payment of these loans that they take. But with higher interest rates, they're not going to be able to afford it, and the house of cards is going to come down. And yes, we are in for a recession. You don't have to look at graphs and charts and all this other stuff. The Fed is going to aggressively raise interest rates, 0.5% in May, and then 0.5% maybe in June or July. We are going to see consequences of it. We saw consequences of it today in the stock market when it was down almost 1,000 points, 981 points. And if that was just on fear, well, people know what's going to happen. So don't borrow money right now. It's not the right time. You know who's going to fail? 50% of small restaurants. That is what is predicted. The Restaurant Revitalization Fund, there was criteria to give out this RRF. It was to minority-owned businesses, it was veterans, it was women-owned businesses. There was criteria. But who got the majority of the RRF? Dunkin' Donuts, McDonald's, concession stands at stadiums, hospitality companies, restaurants, wedding venues, and the like. They are the ones that got the RRF. Multiple event spaces, airport concession stands, historic hotel in Bethlehem, Pennsylvania, Panera Bread, Five Guys, Dunkin' Donuts, Buffalo Wild Wings, and Chuck E. Cheese, and that's just to name a few. They got over $10 million in RRF. And your local pizza shop or your local small little Brazilian or Italian restaurant, well, they didn't get any. And those are the ones that are going to close. Matter of fact, Dunkin' and McDonald's, they got the money, not the franchise owners. The companies got it. You think it trickled down? No. So don't be surprised. They say that restaurants are booming right now, but they hired the most people, but they're also the industry that is still 10.5% lower or fewer workers than there were before the pandemic. A lot of things are going on behind the scenes. And the price of food is going to keep rising. There is still going to be supply chain problems, but we are going to see a slowdown. And to be honest with you, we need to see a slowdown. We live in this instant gratification world. We want it now. And we have the powers to get it now. But that's not the way life's supposed to be. You're supposed to save for something. And you're supposed to anticipate it and not get that instant gratification. Well, if you weren't able to buy a house when the interest rates were low, Maybe you'll be able to buy a house when the interest rates are high but the prices are low. And your monthly price will be the same. What would you rather do? Would you rather buy a house for $500,000 and pay 3% interest on that mortgage for 30 years? Or buy a house, for the same house, for $400,000 and pay a 6% interest on it? Well, I'd rather pay $400 because the principal you owe is $400,000. And if interest rates come down again, you can refinance it for a lower price. But when you paid $500,000 for it, the chances are interest rates won't come lower than what you already paid. But your principal amount is so much higher. It's got to come down. It has to. Just like the stock market's going to come down, and the price of those low-paying bonds are going to come down. That's what the Fed wants. They want to decrease demand by raising interest rates. But in effect, there's still going to be people who want to sell their homes. And if people can't afford to buy it, well, they're going to lower their prices. All right, it's all pretty much common sense, but thank you so much for watching. As always, I appreciate you. Be kind, call someone, tell them you love them, hit like or subscribe to this channel, and we will talk again real soon. Have a great day.